What you need to understand about the system is that it's a headwind and it screws the saver mentality. If you live within your means and you just want to try to live a quiet life, compound your money in a safe way in savings and be financially independent, sorry, not going to Florida happen. Not here, not now, not under this system. So what do you do about it? Hey everybody, welcome to the Curzio Research YouTube channel. I'm Daniel Creech, research analyst here at Curzio Research. Today, I want to talk about a cold, hard truth. That is, you cannot save your way to financial freedom. You cannot save enough to be financially independent. Now, what do I mean by that? Well, if you just want to save money in a shoebox or a piggy bank like I'm showing here, and you want to just accumulate dollars and watch the amount only go up, you don't want to take any risk, just save, save, save. I'm here to tell you the system, the environment, the financial system that we operate in that is around us, that you cannot control, is rigged against you, saving to financial freedom. And I'll break that down. Before I do that, I am not a doomsday bunker builder. I am not the guy to say, sell everything and, bury your cash or your gold in your backyard. Absolutely not. We can have as much fun as we want to with this, and this is fun. You have to learn to smile about this thing or it'll drive you insane. You don't want to go insane. You want to stay in the crazy lane. Crazy is better than insane, just like the late, great Waylon Jennings sang about. Saving to financial freedom. Now, what else do I mean when I say you can't save enough? Well, because the system that we operate in is a inflationary system. Now, what do I mean by that? It means that the dollar that you have today is going to go down in purchasing power, meaning a dollar, you've heard the saying, a dollar today is worth more than a dollar tomorrow. If you haven't, you've heard it now, you're welcome. And what that means is we're going to talk about inflation and the inflationary system that we have. Now, to have some fun with it, essentially our system is backed. What is the US dollar backed by? Some people say, well, it used to be backed by gold, and that is true. You can see here on this Internet Google headline that until August 15th, 1971, when President Richard Nixon announced the United States would no longer convert dollars to gold at a fixed rate. Okay, so you could argue, well, going back to the 70s, we had gold backing the dollar. Now what do we have? We have nothing backing the dollar except for our U.S. military, which is the greatest in the world. And really what we have here is this system that's a combination of what I like to say Willy Wonka and Wizard of Oz. Now, this is a AI-generated photo. I just had some fun typing in. Willy Wonka, I'll give it to him, looks halfway like Willy Wonka, what you'd expect. I'm not really sure what the guy on the right is here or where he's looking. They're both looking past the crystal ball, but that's okay. But I say we have this Willy Wonka, Wizard of Oz type of financial system because we're no longer backed by anything. And that is an inflationary system. So when you print money, and this is one of the reasons why Bitcoin and gold get so much attention, and deservedly so. Because while you can mine for more gold, there is quote unquote a limited amount, and the supply grows slowly depending on mining for it. With Bitcoin, you have a fixed amount at 21 million. The mining is done through computers instead of digging holes in the ground like gold, but you have a fixed amount of 21 million that'll be achieved at a certain deadline. So those are not, gold is inflationary at a slower pace. Bitcoin is not really inflationary in that standpoint. Our US dollar system, backed again, a combination of Willy Wonka and Wizard of Oz, is inflationary because the more dollars you print, the more you put in circulation, the less purchasing power each dollar has. And again, this is the Jeopardy answer here up front is to invest. You can't save enough, but you have to and you should invest to financial freedom. And while we're big components here and fans of stocks, we think everybody have exposure to stocks because capitalism is the greatest wealth builder that we've seen in economic history. But you must invest in yourself, learn about habits and interests that you have, and put them to work for you. You can invest in stocks, you can invest in real estate, you can invest in small businesses around your community and close to you. That's keeping things a lot closer to the vest, and that is not a bad idea. That is a great idea. In fact, that is one of the best ways to build wealth because you can control a lot more of the components and the elements the closer you are to that. When you buy a stock, you have no real voting power and you're, wherever they're away, you're here at your desk. And that's okay. The point is, invest in yourself. Think about investing and putting your money to work for you, because savings is not going to get you there. Now, let's look at, so we're talking about this inflationary system we have, and I'm going to show you a chart here, and the numbers aren't as important as the direction. And this is from the Federal Reserve Bank of St. Louis. And you can see here that we're looking at the purchasing power of the consumer dollar in the U.S., in the cities. So again, the numbers on this chart are not as important as the direction. And you can see clearly we are going from the upper left to the lower right. The lower right simply means that your dollars are buying less and less for you. Now, said another way, if you look at, here's a fun website, Smart Asset, and this is where you can put in, so the previous chart showed you about your purchasing power going down. This just illustrates that in a different way. Here you have $100, and you can pick the year. I picked this year because this is the wonderful year Daniel, was born, 1986. So if you fast forward to today, it would take $294 essentially to buy the same amount of goods as $100 bought back in 1986. And now, as you move this date around, so if you move it more recent, up from 1986, but more recent, you'll see that this dollar goes down, as it should, because inflation should be a little bit less since 1990 to 2025 than it was in 86 to 2029. And you see how that is illustrated through the chart. And now the point here is that, okay, if you think about savings in this piggy bank or shoebox that I showed you, then you're stuck to earning interest on that money. And of course, that's fantastic. You ought to look, and that's one way to put your money for you. But here's the issue with interest rates. They are dictated by the Federal Reserve, which you and I have no say in. And what I mean by that is the federal funds rate is essentially one of the most important rates in the globe because it impacts or affects all kinds of different interest rate pricing. And so this chart, again, from Federal Reserve Bank of St. Louis, and you can see it's fairly recent. You can see here June 2025. And this goes back to 1955. Now, you'll see the spike in the 1980s, early 1980s, and that was when Reagan and Volcker came in and had to hike rates to kill inflation because the previous Fed chair president kind of, inflation was high, they raised hikes, and then they lowered rates, and then it came back, and then Volcker had to really just smash. I'm sure a lot of you have heard that. If not, go down the rabbit trail and just say, type in, hey, how high did rates go? Why did they go as high as they did in 1980? It was to crush and get a handle on inflation, the same arguments and scenario you're hearing now. The big difference here, of course, is that we are only at 4.25 to 4.5 on the interest rate right now. The main point I want you to take away from this chart is the lost opportunity cost, okay? So if you were able to invest in CDs or safe bonds, and we use safe loosely here, you were locking in incredibly high rates right here. So you could argue and you could say, well, Daniel, if I'm saving all my cash and I'm putting it to work in super safe treasuries or CDs, well, I could get great rates and I just need to compound that over time. Yes, but that would lead to massive opportunity costs because the best thing about compounding is what? Time. The longer, the better. And the time to start is right now, and the better time was yesterday, okay? And so what I want to share with you is why this is no reason to be steady. And if you look at historical bank rates, and this is bankrate.com, and I thought this was a pretty neat chart. So if you look at this federal funds chart, and again, you see the spike in the early 80s, which makes sense with these higher CD rates. This only goes back to 84. But you can clearly see the blue line here is 6-month CDs, green line is 5-year CDs, and then the purple line is 1-year CDs. Now, if you would have locked in this 5-year CD at 11.71%, that means you'd be earning 11.71% for 5 years, and then you'd get all your capital back, and you can go and reinvest that rate again. The issue is you can't control that rate. You can't lock in that rate for any amount of time over what you're offered. So when they say, hey, we'll give this to you for 5 years, you can't say, well, I'll take it for 20. Now, if you bought Treasury bonds, you could have locked in higher rates. In fact, going back to when I was in the brokerage world in 2010, I remember clients' bonds coming due, paying double digits interest rate, and they were very disappointed and upset that they were not going to be able to put that same amount of money to work at anywhere near the interest rate. Now, and when I say you can't lock in a 5-year CD for 10 is because you're only getting offered what the banks are offering you. Now, the point here is that even if you locked in the highest rates, when you go to reinvest your money, you are significantly getting a lower rate of return. And that's not the full story, because the full story is you have to look at the rate of return you're getting, how you're putting your money to work for you at the same time about inflation. And I just showed you how the purchasing power is going, lower with the dollar, and you have the cost of everything else moving higher. And I'm talking about the cost of groceries and gas, the same song and dance that we are arguing or aggravated about right now, coming out of we're still dealing with higher inflation than what consumers would like, but we're coming out of a period of much higher inflation out of the COVID era. And now, while some individuals are seeing wage increases, if you're just trying to live off of a fixed income or a savings income, then you understand and you can feel the other prices of everything else going higher. Now, recently, we've had some lower pricing in some food, and some inflation has come down. Some gasoline prices have come down. But overall, you know what I mean, from a larger picture of coming out of COVID, a lot of prices are 20 to 25% higher than they were 3 and 4 years ago. But your wages didn't keep up with that. And also, your savings rate did not keep up with that. And that is what I want to continue to make sure you understand. Because this chart, again, shows you that unless you're locking in for long term as long as you can, you are reinvesting at much lower rates. And the problem with that is the opportunity cost. So if you notice here, you go down to the market crash of the dot-com boom, bust, and interest rates go down to under 1%. So we're going to say 0.5% to 1%. And, they were essentially there for 3 years, 4 years, until they rallied, until they got raised. This is going into the housing crisis, and then boom, we had the great financial crisis. Now, from 2008 all the way until 2018, basically 10 years later, the federal funds rate, outside of a brief spike, was under 2%. Okay? That is why during the great financial crisis and until just recently, in fact, 2022 really, when the Fed started hiking rates, interest rates essentially went to zero. Now that did bonkers for the housing prices and for people wanting to borrow to buy a house, because you could borrow at incredibly cheap rates. But that screws over the savers because it lowers the amount you can earn. And that brings an opportunity cost. So looking at this chart, from 2008 to basically 2020, you earned next to nothing on CDs and interest rates on your savings account. Next to nothing. And what did I say about the most important thing about compounding? It takes time. So even if you could take advantage of these higher rates of, say, 5-6% back in the late 90s, unless you locked it in for as long as possible, when you went to reinvest, you had next to nothing, and then the opportunity cost and earning 0% on all your money. So you're still trying to save away. You're still adding to your savings. You're being disciplined. You're not getting rewarded. And again, that's only half the story. The other half is much worse. It's because inflation is absolutely eating your purchasing power away. Now, you can type into any Google machine you want to, or any AI model, and over the last 30 years, you'll come up with an inflation rate that's eaten your purchasing power by roughly 30 to 50% or more. So this wonderful piggy bank and shoebox that you're stuffing full of money, if you put this under your bed for the next 20 or 30 years to give it to a grandson or a son or a nephew or whatever, it's not going to be able to purchase half of what it does today. And that is absolutely horrific. And that is the purpose of, or that, unfortunately, that is the purpose of the system. And it is the impacts of this inflationary system. Now, I'm not calling for a revolt and, well, then quit paying taxes and just, what are we going to do about this? First of all, just understand the difference between savings and investing. Very simple. Risk. Risk is not enough to stay away, though. So savings only goes one way. That goes up. Safe, by definition, meaning no risk of loss. So whenever you check on your savings account, you know it's at least going to be that much. If you're earning interest on it or something, it's only going to go one way. Investing takes on the idea of risk and risk of loss, risk of capital, and permanent risk of loss, meaning you're down on a position and you cut and you run. That money is gone forever. Now you have less to move forward with and try to invest or do something with. So understand, hey, you have to take on some risk because of the environment around you. Now that may seem worrisome or even downright scary, but don't let it be, because it's not. The trick is, and we can have some fun here if you want to get tinfoil hats on and conspiracy, because you hear a lot of people on the internet and arguing that the markets are fixed and this is fixed and it's, trickle down economics and it's only for the fat cats and yada, yada, yada. Well, every good joke has a little bit of truth to it. But the point is, what you need to understand about the system is that it's a headwind and it screws the saver mentality. If you live within your means and you just want to try to live a quiet life, compound your money in a safe way in savings and be financially independent, sorry, not going to happen. Not here, not now, not under this system. So what do you do about it? Well, you understand the rules and the environment around you that you did not choose and you cannot control, and you play by the rules. And that way you can benefit you and yours to be financially free, if that's something you want to do, which I would bet it is. Now, I said earlier, how do you do that? You want to go and invest in yourself, invest in stocks, invest in real estate, small businesses. The point is you want to invest in assets, because the inflationary system that we have, again, headwind and terrible for savers, is a tailwind and like a tsunami for asset prices. All right. Asset prices are going to continue to go through the roof, partially because an inflationary system is devaluing your dollars. For proof, let's look at a chart. We're going back to the old Federal Reserve Bank of St. Louis. This is from April of 2025, so it's not completely up to date, but you'll get my point here. And it's not so much as the numbers, but the direction of the chart. So here's your average sale price of houses sold in the United States. So we're looking at home prices. And you can pick, this goes back to 65, but we used 1986 earlier. And you can see that it was around $106,300 then for your average selling price of a house in the United States. Look at the far right end of this chart, and you're over $500,000. Even if you were at $400,000 like we were, and the chart shows in 2020, or maybe even 2021, the point is that asset prices are skyrocketing during the time that inflation is skyrocketing and screwing the savers. Okay? You have to be disciplined enough to save in order to have money to invest, but you must invest and put your money to work for you. I'll show you another chart, or just another, Google search or whatever, because I just showed you real estate asset prices in that sense. If you want to look at the S&P 500, and again, going back 30 years, this is going 94 to 2004, you're going to find, and don't get too caught up in the details, not that details aren't important, but depending on when you want to start, and if you want to look at 30 years, 40 years, 50 years, whatever, you're going to get a market return of roughly 6 to 8 or 8 to 10%. Let's just say 6 to 10% on average. Yes, you have down years. Yes, market crashes, market pullbacks happen. I'm not ignoring any of that. I'm talking from a macro level. So you have the headwinds towards savers. You have stocks averaging a lot higher, because why? Well, because asset prices, unlike real estate that's not liquid or real liquid, stocks are very liquid, and you can easily buy and sell stocks. And the irony in inflationary systems are you want to be in asset prices because dollars are losing their purchasing power so quickly. You want to have them in assets, because let's get crazy here. If you have a Berkshire Hathaway that owns all these amazing businesses and produces tons and tons of cash flow, if the dollar loses its reserve currency, and those are priced in francs or yen or whatever, unless the world stops and the businesses stop turning out products, it does matter. But for education purposes, it doesn't matter what those are priced in. You still have assets, you still have generating products and services that can generate income, however you want to measure that. Maybe it's in Bitcoin. Maybe we're all going to measure in Bitcoin soon. But the point is that the inflationary system is a headwind for savers, but a tailwind for asset prices. So get yourself some assets is the point. We've looked at, again, housing prices. You looked at the average return for stocks. Now I'll just switch over and even assets like gold and Bitcoin. So here's a quick CNBC. Here's the last 5 years of gold and then all years. Over the last 5 years, you can really see this has really started to take off since 2023. And again, when you have excess inflationary measures coming out of this COVID, we've dealt with an inflationary period that we haven't seen in decades. And the good news about that is it draws attention to the economy, to the system around us. And that's a net positive, because what I want you guys to take away from this is there's a lot of noise out there, but you must put your money to work for you, okay? You cannot be fearful of risk or risk of loss. It's a part of it. You can manage that through position sizing and stop losses. Please check out my other YouTube videos I've done on stop losses. I'll do further ones on risk in the future. But the takeaway here is do not fear risk, simply manage it. But again, you just have to have a plan. And the plan is you want to be disciplined enough to save, but you have to be disciplined to then take the step, even if it's gut-wrenching or it makes you nervous. You have to put your money to work for you if you want to be financially independent and financially free. All right. So we've covered the Willy Wonka, Wizard of Oz system we're in, why asset prices have a massive tailwind behind them, why savers have a headwind, and that is why asset prices are near all-time highs. You look at real estate, you look at stocks right now, look at gold, look at Bitcoin, all those assets are near all-time highs, and it's not a coincidence, and it's going to continue. The only way you're going to be able to save your way to financial freedom is if you think I'm wrong, and the system that we are living in right now and have been for decades and decades and decades and decades is going to change overnight. That is not a good bet percentage-wise to make. So don't fear the environment. Don't be upset to the point where it drives you crazy. Just understand the rules and the environment around you. Put them to your advantage. That way you and your family can reach financial prosperity. Save and invest. That's how you get there. Please check us out at CurzioResearch.com, Wall Street Unplugged. I get to co-host that with the one and only Frank Curzio. I'll see you soon back on YouTube very soon. Cheers.